All right, I'm back. I had to miss 3 days because I was out of town, but I'm back now. And yesterday, the Fed, yesterday was Fed Day, and they announced, unsurprisingly, a 75 basis point rate hike. A 75 basis point rate hike, which is too little, too late. It is, oh sure, it's the biggest hike that they've done since 1994. Well, this is the highest inflation if you look at shadow stats since what, like 1947? Even the official number is the highest since 1981, and considering that in reality, since inflation is measured differently than it was in 1981, the Fed is being much less aggressive now than they were back then in fighting inflation. Back then, Paul Volcker raised interest rates to 20%, as everyone knows. Jerome Powell has raised the Fed funds rate to, 1.5%? I mean, sure, mortgage rates have doubled, that's a good thing, but mortgage rates are still pretty decent as far as buying a home is concerned. Now, even at the current rate, if Powell doesn't touch interest rates, anymore, will housing prices come down? Well, yeah. Will the prices of stocks come down? Well, yeah, they already have. The S&P 500's in a bear market. But when the price of something goes up, 400 to 800% and then falls by 20%, you're still absurdly high. Stocks are still absurdly overvalued. Housing is still absurdly overvalued. And the price of consumer goods is still rising at a rapid pace. And the only thing that we really have going for us, oddly enough, is that consumers kind of are already tapped out. All of this consumption that people have engaged in has been fueled, by and large, through debt. Not just credit cards, home equity loans, absurdly low interest rate mortgages, bond issuances that have allowed companies to buy back their own stock and continue to bid up the price year after year. But also just good old-fashioned Austrian business cycle theory, low interest rates stimulates investment in business. Those businesses otherwise wouldn't exist with higher interest rates, and so therefore you have all these people who have, well-paying jobs who otherwise wouldn't have, those jobs, or at least they wouldn't be paid as much as they are being paid. They think, hey, I'm being responsible. I'm producing I'm doing my job. I'm not going into debt myself. I don't have any credit cards. I didn't take out an absurdly high mortgage. I didn't, go out and borrow $500,000, even though my mortgage broker said I could. I only borrowed $250,000 so that I make sure that I'm always living within my means. But then even that person can have the rug pulled out from under them when interest rates start to rise because the company that they work for is financed through debt. Their job was financed through debt, through bond issuance, what have you. And ultimately, that's going to be how we control inflation, because the job of a person who's in a business that is an example of malinvestment that only exists because of artificially low interest rates, their job is inflationary. By definition. Their ability to consume is a product of Federal Reserve money printing. And so when the Fed prints less money, i.e. when they raise interest rates and engage in quantitative tightening, where they are selling off the bonds that they own, they're engaging in, what is considered, although this is largely debated how much it really affects the money supply, what's considered to be contractionary monetary policy. Or some might say deflationary monetary policy, although I've also heard some people argue, and this is a tangent that I shouldn't get into for this video, but I've also heard some people argue that, in fact, the Fed doing quantitative tightening is inflationary because the base money in our economy isn't so much dollar bank reserves, but rather U.S. Treasury bonds themselves. And so when the Fed is selling treasuries, they're effectively putting more reserves into the system that can then be levered up and, therefore increase the money supply in the financial economy that way. I don't want to get into that debate, though, because in my opinion, at the end of the day, when it all shakes out, even the people who claim, who debate about how powerful the Fed is and how much of an influence they really have over the money supply, I think everybody agrees that if the Fed was really aggressive in raising interest rates, that would be deflationary. It wouldn't mean that inflation would go negative, but it would mean that it would put downward pressure on inflation. And you can put substantial downward pressure on inflation. The Fed, instead, is choosing not to do that because they're trying to minimize the economic disruptions and the disruptions to the financial markets. But at the end of the day, that's what needs to happen. Malinvestment must be purged. Housing prices must fall. Stock prices must come back down to earth. And you know what? 1.5% on the Fed funds rate, I don't think that it's nearly enough to get the job done. But as fragile as this bubble is, it's going to do a lot of damage. It already is. I checked. I believe the S&P today closed at like 3,666. Not ominous at all. And frankly, there's no sign of a bottom because we're still, in terms of market cap to GDP, we're still extremely overextended. Every price, no matter how much it falls, because it's risen so much, no matter how much prices crash, they're still absurdly overvalued. Now, housing prices haven't even begun to crash. I mean, they barely have. They're starting to a little bit. I mean, the housing market's definitely cracked. But housing crashes, they take a very long time. We got to see inventory spikes first. I'm seeing inventory go up in different markets throughout the country, different bubble markets. And you can find that on Federal Reserve Economic Data. If you just type in, a certain county and then housing inventory, a lot of the times they'll have the data. And inventory is up from the lows in a lot of places, but it's nowhere near pre-Wu flu highs. And it's not like housing was cheap back then. It's pretty rich hearing the press conference begin. And Jerome Powell's first words are, now, I just want to preface this with, we at the Fed, we completely understand how tough inflation is on everybody. It's like, shut up, bucko. I mean, this has been going on for quite a while. You were lying through your teeth on the transitory stuff. You were not accepting alternative interpretations back then. You leaned in favor of being as risky as possible. You said, instead of, leaning towards, hey, you know what, this inflation might be transitory, but why don't we, nip it out in the bud just so that there's no chance? No, instead of doing that, you went as hard as possible in the easy direction, or what you perceived to be the easy direction, and you said, hey, inflation be damned. And here we are. Now we've got the inflation. Now it's been sustained for quite a while. People are in pain. There's going to be a lot more pain. And at the end of the day, you're going to have to do what you could have done back then, which is jack rates up. And you're going to have to jack them up now even more than you would have back then. Because once inflation starts, you got to jack rates that much higher to compensate. And hey, you know what I was saying before about this being such a more fragile economy than it was back in the 70s and 80s? Because we're so much more dependent now on this bubble money. It might not take the Fed raising rates as high as they did back then. We might be able to get by with only raising them, to like 5%. But 1.5% ain't going to cut it. I mean, it's going to do a lot of damage, but it's going to be slow. Why not rip off the Band-Aid? Just get it over with. We need capitulation in every market. Market capitulation is how you get prices down. And yes, that means asset prices too, but it also means consumer goods. If we get people to the point, where they tighten their belt and where consumption then is limited only to the essentials, well, then all of a sudden, stores are going to have to start marking down items even to get them to sell. Yes, we have supply side problems, but you don't want to exacerbate that by stimulating demand, which is exactly what the Fed has done for really my entire life. If anything, if the Fed's job is to, stop the dollar from inflating, if their job is to keep prices stable, when we have a supply shock, the Fed should, if anything, artificially restrict and hold demand back. They should not make it, they should not be stimulating these bubbles, which create fake careers and fake asset bubbles and enable all of this extra consumption. I don't understand what Powell and the gang think that they gain by moving at this snail's pace. I mean, to them, they think, oh, we're moving extremely fast. Well, no, you're way behind, buddy. You should have started hiking back when you first started to smell inflation. Not, what are we, a year into this? This is absurd. This is insulting. It is the definition of too little too late. Yes, I get it. We're not, this isn't the early Weimar period. We're not quite at the point where we need Rentenmarks yet. But it's much worse than anyone should expect from the most powerful country in the world with the, most sought after and most liquid currency in the world. This is not the way that a tier 1 currency should be managed. And I don't even believe in centrally planned and managed currencies. But God, it's an insult to the people who do believe in that sort of thing. But really, this is what happens when you have a Politburo set market prices. You get market chaos. You get these absurd spikes in prices, these absurd spikes in asset values, which should be, at the very least, accompanied later on by equally absurd drops, bringing us back down to earth. Because, I know this might be a controversial statement, the Politburo doesn't always know how best to account for supply and demand across the entire economy at any given time. That's why, for every other good in the economy, we generally try to rely on market prices. Yet the Politburo in the Eccles building in Washington thinks that they're wise enough to themselves set the price of money itself, which in turn accounts for the price of every other good in the economy. So that's where we're at in my estimation. We're in a real bad spot. We're in a tight spot. Inflation is higher. The Fed is still just wallowing in its own failure. And they haven't really gotten serious yet. Yes, what they're doing is going to bring down asset prices. But they need to do a lot more. This certainly is not going to be over before the midterms. And frankly, if Powell had started last year, when he first smelled inflation, yes, we would have had a recession back then rather than now. But it could potentially be over by now. We'd be on the road to recovery. But no, we have a policy in this country going back really to Greenspan in '87, but really most extremely since '08, of never permitting another recession to ever happen again. Janet Yellen said there will never be another recession in her lifetime. Of course, she's wrong, because we're in one now. So, with that said, I will actually see you folks back here tomorrow.